take up tang 7. Okay? Now, 7. 80% owned subsidiary. Computation of consolidated balance sheets. Okay? So we have now your computation of consolidated balances. Slim Corporation's balance sheet on January 1, 2024 reflected the following balances: cash and receivables, inventory, land, buildings, and equipment. We have the total assets. Then accounts payable, income taxes payable, bonds payable, common stock, and retained earnings. Ford Corporation entered into an acquisition program and acquired 80% of Slim's common stock on January 2, 2024 for 470,000. The fair value of the non-controlling interest at the date was determined to be 117,500. A careful review of the fair value of Slim's assets and liabilities indicated the following. By the way, class, I am recording. So if you want to listen to this again, nag-record ako ha. So please, if you have any questions, ask na lang kamo in the canvas, ha? Kay nag-record ako. Okay, so we have now the inventory, land, buildings, and equipment with book values different from fair values. Goodwill is assigned proportionately to Ford and the non-controlling stockholders. Required. Compute the appropriate amount to be included in the consolidated balance sheet immediately following the acquisition for each of the following items. Now, number 1, inventory. Uh, we have to determine the inventory, and initially the inventory is given in problem number 7. We have now problem number 8, no? Actually, problem number 8 is the solution to number 7. The value of the inventory initially was 120,000. However, the fair value is 140,000. So we are increasing the inventory by 20,000. The land, ang iya nga book value 70,000, but the fair value is only 60,000. So we are deducting 10,000. The buildings and equipment, the fair value is 480,000, and now we are recording the fair value, so we add 70,550. So we have now to compute for the full goodwill if the consideration transferred by the parent is 470,000 and the fair value of the non-controlling interest is given at 117,500. So we have now the total of the fair value of the subsidiary equal to 587,500. Now we have the book value of the stockholders' equity of Slim. Ang iyang common stock 250,000, retained earnings of 200,000. So you have the total of 450,000. Now for the difference, that's the allocated excess of 137,500. We are going to deduct the over or the undervaluation of some assets accounts. So we have the inventory originally undervalued at 20,000, land overvalued at 10,000 and building and equipment undervalued at 70,000. So we have now the net book value to be adjusted at 80,000. Now we have to deduct the allocated excess of 137,500. We are going to deduct 80,000. So we have now the full goodwill of 57,500. Or we compute for the full goodwill by deducting from the total fair value of the subsidiary of 587,500. We deduct the book value of the net assets. So we have now 450,000. That's the amount of the common stock and retained earnings of Slim, representing the book value of net assets. And then we are going to add undervaluation of inventory, overvaluation of land, and undervaluation of building and equipment for the total of 530,000. Deduct from the total fair value of Slim. So we have a difference of 57,500 representing goodwill. If we follow the partial goodwill approach, then we have the consideration transferred by the parent, and we have to multiply the book value of the stockholders' equity of Slim of 450,000. We multiply it by 80%, being the interest acquired. So we have the allocated excess of 110,000. And we deduct the undervaluation of the assets and liabilities with inventory here of 16,000, land of 8,000. We are multiplying this by 80%, and we have the buildings and equipment at net by 80%. So we have now the difference representing a partial goodwill in the amount of 46,000. Okay, that is if you have partial goodwill. Then in number 5, what will be your investment in Slim Corporation to be reported in the consolidated balance sheet? Now, if we involve the consolidated balance sheet, there will be elimination entries, and we are eliminating the reciprocal accounts. So one of the reciprocal accounts that should be eliminated is investment account. So if we now eliminate the investment account, then we have to close investment account by a credit. So credit investment. In other words, the investment account will have a zero balance. That's in the consolidated balance sheet. Next, number 6, how about the total assets? The unadjusted total assets of Slim is 750,000, and then we add or deduct the adjustments: increase in inventory, decrease in land, increase in building and equipment. So we have now the adjusted assets in the amount of 830,000 for the adjusted assets. Number 7, the total liabilities is the given liabilities, accounts payable, income taxes payable, and bonds payable for total of 300,000, there being no adjustments. And in number 8, controlling interest or parents, stockholders' equity data are not given. So we cannot provide this. Non-controlling interest is 587,500, and we multiply it by 20%. We get 117, 500. Okay? Now, as stated above, uh, 587, 500 is the sum of the parents' investment of 470,000 and the non-controlling interest of 117,500. So that's 587, 500. Now, for the non-controlling interest, multiply it by 20%. So, 117, 500, or the book value of the subsidiary of 450,000, including the common stock and the retained earnings. And we are going to add the adjustments to the net assets. So we have now the fair value of the stockholders' equity multiplied by 20%. Then we have the NCI. Here we have 106,000 and for partial goodwill. Then we add the NCI on full goodwill as the difference between 57,500 and 46,000. So we have 11,500, the total 117,500. That answers number 9, the non-controlling interest. Now, in number 10, the consolidated stockholders' equity, we cannot prepare because we are not given the stockholders' equity accounts, account balances of the parent. So, we cannot provide for the consolidated balances of the stockholders' equity. Okay, now we go to number 10. Number 10 is push down accounting. Actually, it's number 11 in our solution guide. So, number 11 in the solution guide is actually the solution to number 10, uh, which is the problem in the book. Now, in number 10 here, or number 11, we have the term push down accounting. And if you refer to page 175 for the meaning of push down accounting, it refers to the practice of revaluing on acquired subsidiaries' assets and liabilities to their fair values directly on that subsidiary's books at the date of acquisition. So, at the date of acquisition, directly on that subsidiary's books. If this practice is followed, the revaluations are recorded once on the subsidiary's books at the date of acquisition. So, directly on the subsidiary's books. In other words, you do not need to wait for the consolidated statements, and therefore are not made in the consolidation work papers each time consolidated statements are prepared. Those who favor push down argue that the change in the subsidiary's ownership in an acquisition is reason for adopting a new basis of accounting for the subsidiary's assets and liabilities, and this new basis of accounting should be reflected directly on the subsidiary's books. The above argument is most persuasive when the subsidiary is wholly owned